All right, welcome back, guys. Today, I'm going to be taking you through this particular trade and the rationale behind that. So basically, as you know, I've been looking at the euro dollar for more for from the beginning of the year, and I've been following everything it's been doing over the last 3 months and calling the moves before they happen. And so today I'm going to be talking about the trade taking on Friday, the previous week. And if you are part of the channel, you would have seen this trade. It was a 1 to 21 risk to reward entry. And I'm here to talk about it. And because I had a lot of questions, and I promised that I was going to go over the trade and talk about a few things that led to taking that trade. Now let's get into it. As you know, I always start from the higher time frame. So we are on the 15-minute time frame. So before going any further, I will switch to the higher time frame, and then we'll talk about that and go through the entire trade. So now I'm going to the 1 hour time frame. As you can see, we've had price continuously breaking areas of what you would supposedly call resistance. And this has been happening since the month of April. And we've been following this pair ever since. And I've been talking about all of this. If you're part of the channel, you would have seen I talked about this, the move to take out these highs, and we talked about this reaction here for us to continue to see higher prices and the reaction at this area, which we saw quite all right at this buy to sell candle. And we saw a reaction off of there. And all of these are trades that were taking off on these areas. So, and then we saw a bounce and price went higher, traded higher. So I'm going to break this down now to the lower time frame where some of these trades were taken. Now we're going to go to the 4 hour time frame, and this is where we will start from in the breakdown. And first of all, the break of the first high here, we saw that the break of that high and price traded higher. And we saw a continuation to the upside and then a reaction at the previous area of resistance, which turned out to become support. Now, price traded higher. Now, upon trading higher, we saw a sell to buy candle and price returned in there. And so we saw institutional orders built up from there. And if you saw, I took a trade there a week ago, 2 weeks ago rather, and that was a one very good trade that ran all the way, breaking the previous highs. And you can see we had all of these areas where we had trade positions running. Now I'm going to break this down further so we can follow the story. One thing you want to do is you want to follow the story of one particular pair. If you are able to follow the story, then you would be able to tell what it's about to do. We had a sell to buy candle or a sponsored candle, price traded back into that. We saw the reaction and we were able to get in on a lower time frame, and we saw the rally. Now, upon trading higher and breaking these highs, we saw, I highlighted this area and I told you that we were going to start seeing a weakness in the dollar, a decline in the price of the dollar, a price of the euro dollar. And we would start to see a rally in the US dollar major. Now, if you look clearly, you'd see that we have a buy to sell candle or a sponsored candle or an order block. That's the most popular term. And that, when you extend that all the way, you'd see that we'd seen various reactions to that area. on an institutional level, and we saw another reaction to that area, and we had a trade around there. So I'm going to break this down piece by piece. So let's go to the we're going to go to the 15-minute time frame, and we're going to look at every trade one after the other, and before getting to the most recent trade that we had. So all of these are trades that are verifiable that you can actually go find on the channel. These are trades that we're taking live. And for the because I've been so busy, it's been difficult for me to record live executions because I'm busy and I'm not before the screen 24/7 as I used to be. And so I have other things taking my time. But here's the thing. This was a very first trade. This was that resistance area. We saw a reaction. We saw a reaction. In this case, this was a distribution, and we saw price decline. We went back to that area again. We saw another distribution, and we saw a decline. That was one trade there, 1 to 20 risk reward, and then returning back to this area, which happens to be an order block or a sell to buy candle or a sponsored candle, we saw an injection. This would have been the entry, but we saw an injection and we saw a accumulation or an accumulation formation around that area. And that became the signal to look for higher prices, going back to the area of sensitivity that we had before, and price traded higher as we would expect. And this trade was just for a little, just around 1 to 15 risk to reward. And it traded more than that. It traded above this structural area that we were looking for. It traded above this high. It would react to the high, trade lower, and capture more orders at a lower price. And we saw price trade higher and trade back into this higher time frame sponsored candle area or area that sensitivity that we were looking for. And what we saw was a reaction, and we saw what I'm going to call another distribution pointing to the fact that we were going to see a decline in price. And what I did was I pointed this out before it happened on the channel, and I told you guys that we're going to see a decline in the dollar the moment we saw price hit here that morning. And what happened was I actually look for lower prices. I asked you to look for lower prices in the euro dollar and to expect higher prices with the dollar majors. And then we saw this return or a retest to previous areas of what you would call structural demand or structural supply, not a demand. I'm sorry, I sometimes confuse these terms. So a structural or institutional area of supply. And so what's going to happen, or what happens, is that you will see a return to these areas because for the purpose of mitigation. I'm not going to go into more detail on that, but I'm just going to keep this simple. And you can see that we had the last bullish candle or up close candle before the rundown in price, which is your SC candle or your sponsored candle or whatever name you call it. And we saw price return into that candle. This trade was taken live on the group, and it was for a 1 to 15 risk to reward. And we saw price trading back into this previous area of support or resistance, and it became a support area, and we saw price gaining momentum on that particular area and pushing higher. But the bearishness of the euro dollar had not stopped because we were going to see more reaction to that area. And I want you to look at what happens here around this area. The reaction, really sharp reaction, price trades back into that area. Remember what I call that? This particular area marked with blue is a higher time frame area for supply or institutional supply. It's not the regular type of supply demand type of trading, but institutional supply. And so you would see institutional orders are going to be lining up around that area. So what happened was the following day, we saw the same reaction. And I want you to pay close attention to the wick. This particular wick was lower than this particular wick. That is a type, that's a sign or that's a signature that tells you that we had just higher price failed to trade higher, and it broke that structure. It shifted, and we saw taking out of interest below the lows. So what happens is we have on lower time frame, we have an area here of institutional supply and price traded in here, and that was the entry for that particular day. That was a Friday, and that was the entry, and price traded lower. It traded lower back into this same area. Now, I want you to take into consideration how you can stay within a zone and understand how the market is going to react to that zone. Now, I'm going to go to the 4-hour time frame, and so we can see, we can look at what happened. Now, look at the zone. The very that was 2 weeks ago. The trade that was taken there, price traded higher, broke the highs. And I want you to see how everything that we've been talking about has played around the previous area of resistance. And that has become a support or a structural level for the market to play with. And look at that area. So we get a signal in price telling us that this area is still going to hold, or we're still going to see price play around here. There's not enough strength to push the price higher or to have higher prices. So let's go back to the 15-minute time frame, and we're going to increase this a little. And so when you see the reaction week by week, that is the signal that you need to understand that that area is still a sensitive zone, not just a sensitive zone, but it's an institutional area. You want to take that back, go back one layer, like you want to go back to the higher time frame to look for sponsored candles, if that area is an area for an institutional demand or an institutional supply, where we're going to see institutions stacking orders. And how do you know if or when institutions are going to start stack in orders in a particular marketplace? If that area has been reacted to multiple times and it gets back there, as we see here, and it just fails to trade into that area, it gives you a lot of weak action or price action around that area, price going sideways. That is another sign. The same that we see around here, that is a sign. And when you see what I call an injection, what I mean by an injection is where you have a whole lot of one-way flow in the marketplace, like here, and you see just so much price movement in just one direction and in one candle, and then there's a really huge rejection, and price stays within a sideways direction. That is to tell you, or that is a signal that you're going to see that we are having institutional orders being stacked. It could be in the form of an accumulation, or as the case may be, a distribution. But everything has to be in line with the higher time frame, what I call the superior context, or the higher time frame narrative, or what I call just the trend, if you want to call it that. So it has to be within the superior context. We kind of break this down into a lower time frame and just talk based on a lower time frame. But we have to look at things based off a superior context, which happens to be a higher time frame directional basis of price movement. And in this case, we saw the same reaction here. We saw price reacting to that area, which I highlighted earlier on the daily time frame and the 4-hour time frame. And we saw the same reaction, which breaks this high just by a pipette, and then it trades lower. And then we see a shift in market structure, and then a return into that area that gives you an entry. You're going to find an entry around there with very low risk and high reward. So the stop there was around 2.9 pips, and price traded way back into the area that we have been talking about, and that becomes that was a 20 1 to 20 risk to reward. And that's the same reaction. Now, if you look at Monday's trading for today and break this down, this right here is an injection. What does that tell you? It tells you that we're going to see higher prices, at least around or within this zone. Okay, at least around or within this zone. And what happens is that we saw that injection here. And what next? You see the same signs that point to the fact that you have institutional stacking of orders. And what happened next? We saw price traded higher, but it doesn't just trade higher, it returns into the last area of the last SC candle or the last down close candle before the move up. And that was an area for a mitigation, and price traded higher. And now it doesn't just trade higher, it trades into the last right here and reacts to that area. And there is no surprise. It shouldn't be a surprise whenever you see something like this, because this is what you call an institutional reaction or institutional areas to look for. And this right here is the last up close candle before the move down. And that becomes an area or an institutional area for supply, an institutional area for supply to look out for. And that you could actually use that for to go short and trade within this zone and this zone all the way back into this particular area right here that has been tested so many times. As for the direction of price, let's go back to the 50. Let's go back to a higher time frame, and in order to identify or tell or have an idea of what has been going on so far, if you look here on the higher time frame, you're going to see that price had been progressing in a stepwise or staircase like type of progression, and we're seeing a reaction of this area. Now, if you look here, you'd be asking yourself, why did you pick this area? Because it's just on the wick, and we've seen the reaction there. But if you go back to the 15-minute time frame, you already understand why that area was picked, and now we're seeing price reacting to that area. Now, let's go further to the daily time frame, and we will wrap this up. Now, if you go to the daily time frame, remember what I just said a few minutes ago, that how do you tell when we have institutional stacking of orders? When you see price reacting to a particular institutional area, maybe demand or institutional supply zone, and stacking in orders and moving sideways. On a higher time frame, if we were to look at this, this is a sideways movement, and it's not really decisive. So we're either seeing a move that would really push price break this particular area that we have seen a lot of reactions to, and trade back in here before continuing all the way up. Or we could just see a movement all the way up. I don't know what it's going to do. I can tell you I know. But what I know is there are certain things that you can look out for, which I look out for. And when I see those, I can actually tell what we're going to see next. And that was how the trade was captured. And you really want to pay attention to the higher time frame, the superior context, the direction of price. Break that down and look for areas like this for a reaction, higher time frame institutional reaction, demand zones. Now, I want you to take this into note. When I talk about a demand zone, I'm not talking about an area where you have more buyers than sellers. Well, that is the case, but it is not in the, it doesn't reflect the real thing that happens around these zones. Basically, what happens is we have orders large orders from large institutions, exchanging hands at those areas. They're willing to buy at that particular area, or they're willing to sell large, very large orders at those areas. So basically, that's what we're looking for. We're waiting for areas where we can actually determine that the market movers are coming in to do business, and we want to trade off of that. So that is the demand zone, or that becomes the supply zone. It's not because the bulls are taking control, or in terms of retail terminology, or because there's more buying pressure there. If there was anything such as a buying pressure, it is due to the fact that we have institutional players coming in to influence price or to sell off really huge orders at that particular area. That becomes a really huge influence for price. Now, a good example is this area, because we looked at that area and we saw an SC candle, and we said that that area becomes a target for an institutional sell-off. That becomes an institutional supply zone. It happens here once again, and so it becomes a strong level for institutional reaction. And we use that area to get in business with the big players. And that's how you can actually do business here and focus on levels that are more, that's going to give you more reaction on a higher time frame basis. And that's how you can do this. And in the next video, I'm going to be talking more about the trades that I take. So I'm going to see you then, and have a good one, and I'll see you later.